Call to order the February 25th, 2026 meeting of the North Carolina Investment Authority. Thank you everyone for being here. Will you please join me in the Pledge of Allegiance and the salute of the North Carolina flag.
Starting route to home.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. I salute the flag of North Carolina, pledge to the old North State, love, loyalty, and faith.
All right. Some administrative items. First, if anyone wishes to make a public comment, please sign up for the list on the table in the back of the room. Please note this meeting is being recorded and will be posted online with the other board materials. We'll be taking roll call by name for all votes, and unless there is objection, a motion and a second will be counted as yes votes. Finally, texts or other recorded communications between board members during the meeting, even on personal phones, are public records to the extent that they concern the meeting. We'll now do a roll call for attendance.
Very good. Ms. Lynch?
Present.
Ms. Shipping Russell?
Present.
Mr. Roberts?
Present.
Mr. Ward?
Present.
Treasurer Briner?
Here. All right, we're all here, and I probably should have done this in a different order, just to introduce you to Bill Watts. Bill is the new general counsel of the North Carolina Investment Authority. Under the charter of the NCIA, the general counsel serves as the secretary of the board unless you appoint someone else. So he's the secretary of the board. Prior to confirming this appointment, I just want to thank Ben Garner for all of his work. I don't know if he's listening today, but I hope he is, because the efforts that he put in on behalf of the former state treasurer in setting this entity up were truly Herculean. So thank you, Ben. You have some big shoes to fill. I'll now accept a motion and second to approve the resolution of the board of directors to appoint Bill Watts as the board secretary of the North Carolina Investment Authority. So moved. Thank you, Mark. Thank you, Stephanie. Is there any discussion? No, let's call the roll, please.
Ms. Shipping Russell?
Yes.
Mr. Ward?
Yes.
Treasurer Briner?
Yes. All right. Thank you. We're moving on. In accordance with the State Ethics Act and the board's code of ethics, it's the duty of every board member to avoid both actual and potential conflicts of interest. Does any board member have any known conflict of interest with respect to any matters coming before the board today? So please identify the conflict and refrain from participation. Hearing none, over to statements of economic interest.
Thank you, guys. Board members, in your board pack and your board materials, you'll find statement of economic interest evaluation letters that were issued to you guys by the State Ethics Commission. These SEI evaluation letters are being provided for board members' review and for recording in the minutes pursuant to the requirements of the State Government Ethics Act. Members are encouraged to review the evaluation letters to inform and remind them of any identified actual or potential conflicts of interest. Please let me know if you have any questions. If not, Mr. Chairman.
Thank you. So I invited the U.S. Women's Olympic Hockey Team here. No, good morning. Welcome, everybody. North Carolina Investment Authority's first regular board meeting. We've had a number of board meetings before, but this is the first one where everyone is seated and the entity actually exists. So we are largely through the creation process, and I want to thank everyone who's worked so hard to get us to this point. I mentioned Ben Garner, but there's a number of people in this room who get a lot of credit for getting us here today. Passing legislation is not easy, particularly unanimously in 2025, but that was done by this group and this team. Setting up a new state agency is not easy. We don't have a lot of practice as a state doing that, but this team got that done. And taking on new and higher expectations as a team is not easy. We are capable of it, and it's not easy, particularly publicly, but we are going to do it that way too. As we've seen already, though, for 2025's results, this all matters tremendously to our state. For too long, we've let employer contributions rise. Next year, taxpayers will contribute $3.5 billion into teachers and $1.5 billion into elders, representing 17.5% and 15% of salary, respectively. Those numbers not too long ago were 6%. For too long, our retirees have suffered from inflation, robbing them of their purchasing power. It's been a decade since a permanent COLA was enacted in Elders, and that one was 0.1%. The last one we've had over 1% was in 2008. Most of my children were not born by then. But the efforts of this board and this team and the General Assembly as well put North Carolina on a new and a better path. Through the development phase of North Carolina Investment Authority, but now it's time to deliver even better results. And we'll hear about those results this morning. Spoiler alert, they're good. The team gets a lot of credit for everything they've done so far. We've gone from dead last to middle of the pack. That is an enormous move in one short year. The harder part begins now, delivering excess return relative to the risks we're taking. That'll be a multi-year effort until we see the fruits of the individual decisions we are making in real time add up to success. We look at the investment policy statement today, charting a distinctly different path from an asset allocation perspective. We'll look to adopt an incentive compensation plan for the team as well today, aligning their outcomes with their successes to the benefit of all the people of North Carolina. Those are the two final big pieces of the puzzle we need to ensure the success of the North Carolina Investment Authority so we can all look forward to a brighter future. Thank you again, everybody. And now I'll get off my soapbox so we can get to work. All right. Let's move on to the approval of the December minutes. You'll see those in your pack. If there is any discussion, please let me know. Otherwise, I will look for a motion to approve the minutes of the December 17th, 2025 NCIA board meeting.
So moved.
Thank you. Is there a second?
Second.
Thank you. Is there any discussion? Call the roll, please.
Ms. Lynch,
Yes.
Mr. Roberts,
Aye.
Treasurer Brenner.
Aye. Let's move over to the major initiatives and performance update. For that, I'll hand it to Kevin.
Yep, great. Thank you. Appreciate everybody being here this morning, and Matt's going to flip the screen for me. Okay, cool. So just a couple things in the major initiatives this morning. I'll touch on the ongoing transition that the chair has already referenced. So since the December meeting, we hit our day one, which is January 1, 2026, where all the powers, responsibilities, and authorities moved over to the NCIA, the state treasurer, and the department. And to date, nothing was missed, nothing hit the floor, which is always a challenge in something of this complexity and magnitude. But we've really just been moving along in good time since January through currently. All the NCIA employees were in their position as of January. We had the investment processes both dialed in, the management policies that were necessary had all been approved by the end of 2025. And then we have quite a raft of legal agreements, as you might imagine, for all the investments and services. And so those notices have gone out and they've either been treated as assignments or we've had to clarify a few agreements, but nothing major. So that's all in good shape. Today, we'll talk about the asset liability study, last piece of it, the recommendations that are coming in the form of the investment policy statement and then the transition. We're continuing to hire folks. So a few positions on the portfolio management side, notably with some experience in direct investments, and then HR, accounting, and other functions like that, IT, business analyst as well, are in progress. So I want to turn it over to Bill to talk about one of our policy initiatives that have been referenced before, which is building out more of an institutional compliance framework around regulatory issues.
Thank you. So as Kevin mentioned, we're in the transition plan right now. As part of that, we're updating, we're reviewing, and adopting new policies and procedures. One of the key ones that I've been focused on is the insider and personal trading policy. Basically, what we've done is we've taken the department policy and just enhanced it, try to align it with industry standard for a firm like ours, as well as best practices. You can see the purpose in the slide here, which is to create safeguards against the misuse of insider information, ensure compliance with federal and state securities laws. The plan or the policy will cover all NCIA employees. It'll also cover those individuals who may have access to sensitive information that we have access to. Some of the key prohibitions or key tenets of the policy deal with the use of MMPI, tipping, as well as front running. So what we're going to do is we're going to put in place new protocols and obligations on employees. First and foremost, we're going to require personal security trading pre-clearance. How we're going to do this is we're currently out looking at industry-leading compliance consulting firms. We'll take on a online compliance group, which is dedicated to us, and through that, employees can pre-clear trades. We will have a restricted list as well, which I think is very important. And finally, we will impose a 3-day wait period to avoid any kind of front running or any appearance of any kind of conflict. Other obligations of employees, they'll have to report an annual holding statement of their securities holdings. Also send in a quarterly transaction report of past transactions. And there will be an annual certification and training, because I think training for our employees is key to understanding the policy. Happy to answer any questions. Yes, ma'am.
You mentioned the appearance, having a conflict of interest or the appearance of a conflict of interest. Are we going to be also avoiding or limiting the appearance of a conflict? Because that gets to be sort of difficult.
It does, and I think it's a really good question. So the way the policy is set up is that it's subject to oversight of our Compliance and Risk and Ethics Committee. Those, I would say, stickier questions, whether or not there's an actual versus a potential conflict, will be socialized in the committee with advice of me and external counsel as need be. The purpose of the policy really is obviously to ensure we're complying with federal and state securities laws, but also to address potential conflicts of interest. So this is going to be an ongoing conversation with the CRE, the potential employee, or the covered individual to decide whether or not any action should be taken. For example, should a security be placed on a restricted list? It'll be part of that conversation.
Yeah, if I could add a quick comment, I think in the development of our ethics policies, we've really put the emphasis on actual potential conflicts, that those are concrete and can be analyzed from facts and circumstance perspective, right? I think the notion of perceived conflicts gets very murky because in whose eyes is the perception relevant, right? But we still, as a public agency, need to manage our kind of reputational presence. And so there are going to be certain circumstances where perception does matter, and we would take that into account, but through a process like Bill mentioned, through the CRE committee, as well as, again, facts and circumstance analysis.
Having been at BlackRock for a number of years and having to deal with this a lot, I would suggest or encourage you to really be specific as you can, because the appearance of one, especially for a public agency, can really get terribly broad and really handicap everyone, handcuff, I should say.
Thank you.
Hey, Bill, does this include private investments also, the policy, or is that a separate policy?
So an investment in a non-public company, for example?
Yeah.
It would.
Okay.
It would indeed. It would indeed.
Okay. So if there's no further questions on that, I'll touch on another part of the major initiatives, which is strategic planning. And so we've kicked that off internally. We have a small work group. We're going to hire a consultant to help serve as a facilitator. And we think, one, this should inform our budget and how we're thinking about the world going forward, but it's just like the right time to do real in-depth strategic planning with the board. Because the board knew, with our authorities knew, we're trying to redirect the investment program in certain ways. So we think it's helpful to have the board engage early. We'll have the facilitator do one-on-one interviews with the board. We'll have them come here and sit with the team and do a gathering of feedback around some of these key questions around market positioning, competition, what are we trying to solve for, where do we compete, how are we going to win, all of this. And then we'll do a workshop, probably an ad hoc meeting, keep it limited to discussion around strategic planning. And then in May, we would come with some recommended initiatives and how it ties to our budget and that kind of thing. But we think this is the right time for, really, we're still in a bit of a formative stage to a certain extent, right? To do a deep dive on strategic planning. So that's it for the strategic planning and major initiatives. So I'm happy to move on to the performance if there's no questions. Okay, cool. Give me a sec to pull that up. Okay, so just a snapshot of our current assets that we're overseeing. Again, really driven by the equity market. So we're up over 200 billion across all the asset pools, and the performance I'll get to in a sec. But as you can see, it really is still being driven by the DB plan, retirement system, as well as the defined contribution plan. That's where the growth has really been. We've seen a bit of money come out of the cash management program, but that's all driven by the participants and their needs for liquidity. In terms of the macro and the market environment, I'm gonna have Jeff Smith and Ty, you want to come up as well?
Sure.
And so we have a house view group that we work with outside of the investment committee, and then it kind of links into the investment committee. But you hear enough from me that let Jeff, as head of our fixed income team, and Ty, multi-strat, kind of talk about the macro environment a bit.
Sure, we'll hit a couple of highlights on both fronts. So on the macro front, growth remains robust, positive investor sentiment contrasted with some weak consumer sentiment. The K-shaped economy continues to show growing gap. I would describe it as the legs of the K certainly aren't getting any closer on the width side there, with the lower end struggling. Fiscal stimulus in 2026 likely to be a tailwind for at least the first half. And we've seen a few data points on that early. There was some data last Friday, I believe, on the tax refunds data was 10 billion higher than it was a year ago in the last Chigas piece. Our precious metals and dollar debasement related, fourth quarter really saw a steady climb higher all fourth quarter before really got hitting the nitro button in January. I mean, that number that was really straight up at the end of the day on that. Before we had a rapid pullback at the end of the month, and then it's kind of been regaining since then. Markets there. The Fed activity, 3 straight cuts, and then the Fed took a pause as we move towards a change in leadership this spring with the Warsh nomination. Really the pause on the backs of labor markets showing a little bit of stability before that meeting to take that pause. And then new, since we went through the chart, obviously as we have the tariff musical chairs, I'll call it, from moving from IEEPA to Section 122, and ultimately one of those being temporary, and we'll see what the eventual evolution in those looks like. But taking a minute to highlight a little bit on the uncertainty at the Fed, I think is remarkable how much it is, in my time frame. So many questions and layers there. The board makeup, we have the uncertainty around the Lisa Cook case. Does Powell stay on at the end of his transition as chair? The Fed minutes released from the January meeting revealed more of a split on the committee than initially thought, with several Fed officials suggesting there could be a rate hike before a cut. The departing Atlanta Fed president this week made comments about inflation stalling, remaining unacceptably above the 2% goal, and warns it could settle closer to 3% than 2%. Lisa Cook comments this week warning the central bank may not be able to counter rising unemployment driven by AI without increasing inflationary pressure. So the combination of all those things to me make Warsh is going to have a real tough time building a consensus as we see more layers underneath on that. And obviously we know that's not consistent with what's desired by the White House. So I think there's going to be a whole lot more chaos as we move throughout the period, and certainly as we approach, another election cycle here at the end of the day on it. So that news cycle won't slow down, I think, at the end of the day. Right now, futures are showing a 15% chance of cuts in the next 2 meetings, and roughly 2.25 by year end. My personal opinion is I think we're going to have a hard time getting certainly past 2 and maybe 2, the 2 number. So on the market side of things, early signs of equity market rotation, lofty AI spending, favoring cyclicals and defensives, energy, industrials, materials, small and mid cap, outperforming large cap, especially tech. The developed markets, more attractive valuations and growth prospects. And then some dispersion around global central bank policies. You've got Japan on their 3rd hike. You got the ECB on their 5th cut since 2024. And we're somewhere in the middle on pause right now at the end. So a dispersion of actions by the central banks there. Treasury yields have fallen on mild inflation data and also the increase in geopolitical risk. And investment grade spreads really remaining at historically tight levels, and high yield not really far off their bottoms as well either. I don't know if anything else to add or not.
Didn't leave much for me. So just to hit on precious metals, because that's been kind of a hot topic, at least for us in speaking with a lot of the macro managers out there. This has been kind of a longer term secular bull that's been developing since kind of like late 22. And kind of started with some foreign governments starting to buy a lot of gold, mainly, China, Poland, Turkey. And that kind of morphed into more of an inflation hedge for institutions, which, did all right, but started gaining momentum and has now morphed into more of a dollar debasement trade. And that's where it really caught fire this past year. On the institutional side, and then retail came in, and that drove speculation bonkers. And that's where we saw the parabolic moves, a lot more volatility. I think what we've been, speaking about is like longer term. We think the secular trend holds as investors try to diversify a little bit more away from the dollar or protect against dollar debasement, but also against geopolitical risk. So longer term prospects are pretty good. Silver, a similar story, but silver has a use case, right? Used in EVs and solar, and that kind of started with some of these countries, in particular China, starting to hoard resources, which they've been doing for a while. And then that just kind of caught the fervor move up as well. So we've seen a lot more, even more volatility in silver than we have in gold. So pretty interesting dynamic going on in precious metals. What else? We kind of said here, equity market rotation, very early. I'd hesitate to call it a rotation yet, because some of the questions regarding AI CapEx spend in technology are really just coming to light and being recognized by the market. And we kind of saw that rotation into cyclicals, small caps, energy materials over the past 3.5 months. So we'll see if that has legs. I think there's many more chapters to be written in this AI impact on technology over time, but something we're keeping our eye on. And then finally on international markets, again, kind of going back to that multipolar world where we're moving to, a lot of these developed markets are forced to kind of reinvest in their own economies, in particular defense, industrialization, and focus on profitability of the corporations. And valuations are very attractive, and there's more money flowing there now. So we view that as positive for international markets. Smaller for us as a public plan, but on EM as well. A lot of policy changes going on. There's some big elections, kind of particularly in Latin America, a couple in Europe as well, that could create some dispersion among in between emerging markets, and they could be a key player in some of this divvying up of a more polar global macro economy. So yeah, that's all I've got.
It wasn't intuitive to me that we'd get a rally in the 10-year off the back of the tariff news, but we sure have. What's your view on that?
Well, I think the fact that we have so many other ingredients mixed in the bowl makes it kind of tough to narrow it down to that. Obviously, the geopolitical risk on it that's on there, and it felt like a little bit of a old school safe haven trade that we really was off the table for a while. I would attribute a little bit more to that.
Talk a little bit about investment grade and high yield spreads in terms of movements you've seen in
30, 35 basis points in the year-to-date kind of numbers on the high yield type stuff.
Yeah. On a relative basis for high yield, I don't think that's a dramatic move, honestly, at the end of the day on it. Certainly in the IG space, it's been barely, I think we're 5 or 6 off the low. I think that's, and I've thought this way for quite a while. I don't really see it as an attractive valuation point for sure, but I also don't think it's a run for the exits thing right now either. I think balance sheets are in pretty good shape as a whole. I think we should be a little wider than where we are. And that's kind of reflected. We're a slight underweight, credit as a whole, but not too far off because I don't see it steaming necessarily higher either. We've really been the same kind of pattern we've seen really in treasuries. We've been within the 10-year in like a 25 basis point trading range, roughly, barely getting outside of that. We've been in a pretty tight range now on IG spreads there for quite a while, and high yield to some degree as well too on it. So I think that definitely the risk is higher to the upside for sure, but I don't think it's necessarily a near-term risk. We've seen start a little bit of a fracture. I wouldn't even call that. Let's call it a hairline crack. At the end of the day, we've seen some single name trade off. We've seen a little more weakness in your hyperscalers, some issuance there. We saw like Oracle spreads out 25 or 30, but even that, it's been real isolated in the marketplace as a whole. And it has not slowed down any appetite for new issue demand. We're still 4 and 5 times over. Names are still coming in. And there's plenty of appetite for it at where it is. Maybe a reflection, some of them, maybe where some of the global rates are as well too on it. So no change in the market on demand on credit despite that. And that's been the case. That's nothing new.
On the high yield side, Ron can comment on this as well. Most of the negative action has been focused on leveraged loans because that's really where the software exposure is. You want to talk about that, Ron?
Yeah, I think everyone's been worried about AI and its disruption across sectors and even existing software companies and how fast that might ripple through to reoccurring contracts, or whether or not a new emerging player may just completely upend someone else. So you've seen in the tech sector, BDCs get hit hard, mostly because BDCs have supplied the technology market more so than CLOs, and then leverage loans. And high yield actually has the least amount of exposure. So you see the quality gaps, or you see the spreads widen in those spaces based on how much each actor has played in the tech space. We see that as an opportunity for us moving forward. We're looking at opportunities. We're not necessarily they're too fast. We got to wait for an opportunity to be right for us. We're definitely observing, and then we're also rotating. The House Views Committee has been, I think, bearish, but thoughtful around corporate exposure and bearish. I won't say bearish. They've been reflective on that space, and so our portfolio has reflected that. We've been lightening our exposure to corporate credit and rotating into mortgage credit, whether or not it's commercial real estate debt or residential debt, to reflect some of the things that are coming out of our House Views Committee. And that's actually been a great trade for us on a relative basis. And that gives us an opportunity. If we see dislocations in other spaces, we have capital or room to allocate at the right time.
On the credit from the BDC side, kind of lost in all the news there. They actually did some IG issuance earlier this year too, as well too, in the last month.
The BDCs.
Yeah. And so their deals we passed on, for the record. But I think some of those were, they priced way outside where the ranges are in the consensus for IG. So I recall which one. One's around 250 or so pricing on it. And within 2 weeks, it was trading like 320. So the same pressure in that space. They were able to get in and get the deals done. And then as the news got worse, we saw it within a week out trading wider. So.
Okay, so I'll translate that into our current positioning, which again is a moment in time. And later this morning, I'll be talking about the new structure and how we're thinking about transition. But basically, given that backdrop, we're comfortable being a little bit overweight in public equities. notably because we're underweight in all of our other growth asset classes. So it helps when you have a view that is constructive on growth and economic growth and global profit growth as well. And then we've been, frankly, fairly neutral on the investment grade fixed income allocation. And again, there is, certain drivers and factors that are still inflationary that have contributed to the term premium in the Treasury market. But we feel this is reasonable positioning given where we're at. We're in compliance with all of our statutory limits as of the end of the year. All of those have gone away except for two that remain: the liquidity cap and the minimum on investment grade fixed income. We haven't done any rebalancing since October. We've just been kind of minding the positioning. We have had some changes under the covers within asset classes, which some will come up in a second. In terms of our new and incremental investments that we've been making since November, we did $200 million with Bailey Gifford, so that's a late stage venture kind of growth investment. It's a co-investment. So we've done, as I mentioned before, several private investments with Bailey Gifford. The approach to this has been multiple team members from public equity, private equity, and actually the hedge fund team as well. Multi-strat with Ty, and because we had a number of insertion points on that particular investment. Within private equity, HG is a technology-focused buyout manager, large commitment to Andreessen Horowitz. They had a very large fundraise across multiple funds, including their late-stage venture, which is where most of that commitment will go. We hold them in very high regard. We think, notwithstanding the growth in their size, they touch a number of verticals where they're particularly strong. And then they also have a very large operating group to help their portfolio company holdings. On the non-core real estate side, with RXR, one of our strong partners, we did a participating preferred equity strategy focused on multi-strategy, and that's the $500 million. And then we also did a two-building acquisition with Highwoods as our JV partner. And most of that is the pension fund monies, but over time that might rebalance, and we would look at other deal flow with Highwoods as well. And then on the multi-strategy side, Ty's been building that portfolio out. So we have a classic multi-strategy firm, Balyasny. And then we've also done a global macro fund, and we've done a couple of those before, and we're going to continue doing some of those. In the forward calendar, which I'll get to in a sec, we have quite a bit of things coming that are more in the multi-strategy area, co-investment focused, which would be alongside some of these relationships. So if there's any questions on this, the team is here as well to.
I just have a quick question. On the Andreessen Horowitz or others of the really, especially late stage venture growth, how much debt are those companies taking on? And are the funds doing any of the debt side of it? I'm just curious, talking about the amount of capital these companies are moving and whether or not, given the status of the debt market, whether we're really looking at equity investments or debt investments.
I think it varies, but and in general, it's growth, investing for growth. But these are generational companies. You can't start putting onto them. We've seen I don't want to call it extreme, essentially zero, because cash on hand. Some,
but not a large amount of this kind of massive debt loads like you're seeing on some of the others.
Hey, Kevin, quick question. Some of the recent, set aside Andreessen, the recent private equity, traditional LBO stuff is Europe. Like, how are you thinking about Europe versus the US on the private side and setting aside that we've talked about the public side?
Yeah. So on the private side, we see valuations as more attractive. And Europe for many, many years has been low growth, right? But there's a bit more fiscal stimulus. particularly in certain sectors around defense and things like that. It's always been a patchwork as well, notwithstanding the common market effort over decades. And so for well-situated managers that have feet on the ground that can operate in the kind of the more provincial aspects, it's quite beneficial, right? And there's a lot of value to be added. So we have been allocating. We have several in the pipeline that are Europe focused. We have a couple on the screen here. Greg, you want to get back on those comments?
Actually, I just had with them, one of the larger buyout. And, we used to see a lot of money in the US versus Europe. It was hyper investment in the US. And all of a sudden that's kind of changing. There's a shift. More money's going into Europe now, coming out of exceptional exposure to what would be viewed as more attractive as well. But yes, it's a little bit maneuver through the various legal process in many a country, one union, or Europe in general. But more attractive. However, the question is, will those valuations still they go up or will they just stay at a discount US? Or what makes it attractive too, some of the strategies are bring it into the US as well. They're just expansion.
We had one exited investment. We terminated Wellington with a long-standing relationship. It's about $2.5 billion. We took the proceeds. We added to our relative overweight to non-US equities, and then also allocated to one of our internal active equity portfolios that tilts away from Mag 7, the largest cap technology name. So it's a support factor. We did that early in 2025, and so far that's worked out quite well because of this rotation that we witnessed that I mentioned, away from some of those larger cap technology companies that had done so phenomenally well in the last 3 to 5 years. In terms of our forward pipeline, there's a lot, right? And I'll talk about this a little later in terms of the transition. So we're carrying about $12 billion in our current pipeline, where we have fairly advanced diligence, legal, as well as investment, and then headed towards close on quite a few of these. There are some that the numbers are large, right? Even in our context. So there's a $1.5 billion figure here with a co-investment vehicle for private equity, and then $1 billion potential commitment to a infrastructure manager as well. So both of those have a particular characteristic. They're separately managed accounts that we're negotiating, and by and large, they have opt-out rights. So we would underwrite alongside of the general partner, the investment manager, and then within the guidelines, they would bring deals to us, and we would decide whether we want to be in the deal or not. So these are not the standard kind of fund commitment where it's contractually binding from that point forward. And we think that gives a lot of flexibility to us. I'll just focus on the real assets infrastructure. So those 3 lines, the last one is $1 billion. Those are all the same manager. And so it's multiple funds, and then it's a large co-investment sleeve. And again, we get beneficial terms, fees. These are very high conviction managers for us. But we have that ability to opt out on the co-investment side.
It's probably in here, but what portion of the risk assets are active versus passive?
You have a better sense.
For the public equity, it's about 60% passive.
Okay.
And again, I mean, I think think all those other assets are mainly active.
I think with the investment grade fixed income portfolio, that's active, but I would say that that's very risk constrained, both in terms of interest rate anticipation, certainly quality, sector constraints, things like that. Yeah.
I just wondered if you'd elaborate a bit on the underwriting process for those individual co-invests, just generally speaking, what team members are involved, how do you all go about it?
Yep. I mean, it's specific to each team. Typically, there'd be 1 to 3 people working on a deal. They might see it first when it's in the pipeline of the general partner a month earlier, 2 months earlier sometimes, right? So some of these have a fairly slow burn. And then it'll come to the team, so they'll start to get ready if it is approved by the GP, and then we have to have an opt-out. The team is pretty well up the curve by that point. And if they need to get additional resources, either by talking to other investment managers that we have in our portfolio, other limited partners, then they have an opportunity to do that. We're generally, where's Andy? Andy, on the infrastructure side, how soon do you typically see a deal?
We're seeing deals almost every day. So what we're doing is we're building up expertise in various sectors to be ready to process those transactions and where those fall outside of our areas of expertise. For instance, on the energy side, we don't have geologists and petroleum engineers. We put in place a vehicle through a manager where we're opting out and basically cherry picking transactions through that vehicle with them doing the analysis on the underground economics of those wells. So they handle that part, and they re-underwrite, we evaluate those underwriting metrics that and whatever they've proposed, we decide to opt in or opt out deal based on that. But on the infrastructure side, we're developing, just like we're developing house views across the public markets, we're doing that within real assets as well, so that we have an informed view when those transactions come, whether it's battery storage, data centers, transmission lines, ports and terminals. We're having a view well in advance of seeing that deal flow. So we feel that if we can opt out, we're cherry picking from the best transactions of the best managers. So we'll see if we're good at that, but that's why we want to bring in people that have decades of transaction experience rather than just manager allocation experience. We're trying to view ourselves somewhat as peers to our general partner.
Thank you. I would assume, I know you all are building out your liquid allocation now, so you don't have this issue, but would you veto it from a risk concentration perspective, or you felt like you had a concentration at a sector and industry level, something like that? Is that where sort of it flows up to the CIO to ultimately?
Yeah, and so yes, the answer is yes.
Okay.
And then we have, because we have to move in deal time, if the relationship is approved and we have this opt-out right within a separately managed account, then it's an accelerated. So it's typically like a 7 to 12 day time period for a turnaround. For multi-strategy, it would be tighter, right, for a co-investment. But then the team, the proponent that's evaluating the deal for opt-out potential, then does a short form analysis, comes to Chris and I. We look at it. I'm looking at it from the investment side. He's looking at it from the risk and compliance side. And then we have the option to take it to the investment committee. If we feel it's kind of stretchy or there's some particular issues, maybe around concentration. Otherwise, we can just sign for it. And then it's kind of memoed out to the investment committee. And then we review the pipeline and that every week, right, and cash needs. And so it's all synced up with the investment committee from that standpoint. But your predicate that we're building it out, we don't really have concentration risk at the moment, to be frank. We have debates around things like how should we think about the AI impact on various sectors like software. So we have that discussion in the investment committee. We have it in the House View group as well. And I can't guarantee we're going to get that right, but that's one where that's quite tangible for us to try to figure out like what's the right amount of extra compensation to get for committing to some of these general partners that are active in the software space. Yeah. Okay. So I think on other two large tickets here that we're working is another one Ron mentioned, this rotation that's been underway in our credit portfolio, our non-investment credit portfolio. So we're working on another commercial real estate debt relationship, and that would be of size. And then we're looking at, again, a couple of separately managed accounts in the private equity and the infrastructure space where we would have these opt-out rights. Okay, in terms of the performance, I'll be quick on this. Very strong performance for the year, again, being driven by equity markets, notably non-US equity markets. So we're up almost 13% for the year, net of fees and expenses. We essentially matched the benchmark, but we lagged the long-term policy benchmark, which is close to a reference portfolio. It's all public markets. So that would be typical in these type of strong markets. But you can see the strong 2025 performance lifted our 3-year average and even our 10-year average to be above the actual rate of return, which is good news. In terms of the attribution, the right-hand side of the slide at the top shows we added about 20 basis points from our positioning, which is a good outcome for us. We don't take a lot of risk in terms of our overweights and underweights. Some of that came from non-core real estate, where that was a weak market, as there's still a lot of wreckage to clear in just commercial real estate markets overall. So being underweight helped us. The notable underperformance on the asset class level was in public equity. So we had some poor stock selection in 2025 from our managers, particularly in non-US growth manager, strong performance over the long term, but this is a weak year for them. And then we did have some underperformance on the US side as well, hence the termination of Wellington. But if there's questions about that, Rhonda is here as well, if you at all like to drill any deeper on the public equity side.
Is there any other exposure to Wellington?
Yes. We have an international strategy with Wellington, which is more of a bespoke or custom strategy. It has done well for us, and we still maintain conviction in them. It's a long-standing relationship with Wellington, legacy portfolios that we've managed to use within the structure very strategically, but as Kevin indicated, over multiple time periods on the domestic side, that strategy, which is more of an alt strategy, suffered because of the overweight to mid and small over the long periods of time.
Another board I sit on, or more allocation to Wellington, broadly speaking, across different strategies, and they're sort of re-underwriting all of them. So I was curious.
Hey, Kevin, when we report performance on illiquids, are we using 0 for the fourth quarter?
The valuation,
Yeah.
it's quarter lag, essentially, cash flow adjusted.
So September to
So it's
September.
basically September marks, cash flow adjusted through December.
Got it. So no real mark then.
There's no Q4 mark.
Yeah.
They're basically a quarter lag. I mean, they get into the books when we receive the statements. So normally it's like a month and a half later, we get the statement for the prior quarter. So yeah, basically the marks are Q3.
Perfect. Thanks.
Okay, I'm going to jump ahead. Versus peers, as the chairman mentioned, we have been closing the gap with kind of the average or median peer on the return side. Our risk as measured is gone up a bit as we've leaned into the public markets, right? We deployed cash. But overall, the risk environment has been very muted, notwithstanding all the noise in the headlines and geopolitical, the markets themselves for the year were actually fairly calm. And then that's led to some really strong Sharp ratios for pension funds overall, we remain fairly low with our Sharp ratio relative to the other peers. And their risk numbers are a bit lower. They have more in alternatives, which are subject to appraisal, lags and things like that.
So I'm going to make the point that you made to me around short-term risk measures and alternative valuations.
Yeah, I wouldn't read too much into the one-year figures, even 3 years in this environment.
Just to be clear on this, just that the 5 years is ending, December of 25. The next column over is ending December of 23. The 5 years ending 19. Is it 5 years ending? Was it before 2019 or is it starting into 2000?
No, it's the 5 years ending 2019. We were just trying to show kind of different eras, basically, in terms of how kind of performance and the Sharp ratios in particular. So you can see for those 5 years ended
That's what I
2019.
wanted to know. Exactly. Thanks.
So we have almost 50 billion in our cash management program. So just want to mention again that that is invested somewhat longer term than a typical money market fund because it's predominantly very stable money coming from state agencies, excess funds. And so with rates coming down, our STIF account, this cash management program, the yield is now more competitive with some of the alternatives. And with that, I'm going to stop for this particular part of the presentation.
Thank you. So we'll move over to the asset liability study follow-up with our presentation from Mortec.
Mortec is on the phone.
Tom and Ben, are you with us?
Hi, good morning, everyone. Can you hear us all right?
Yes, the floor is yours. Thank you.
Thank you. Thank you very much for having us again. Today I'm joined by two of my colleagues, Gilbert Kruimer, who is a scenario specialist at Ortec, who helped design the deterministic stress scenarios that we are discussing today, and Casper de Vries, ALM consultant, who worked on the analysis in this presentation. They may help to answer some of the questions that you may have. Next slide, please. The presentation will take about 20 minutes, leaving also time for questions. And I'll start with quickly discussing where we stand in the process of the ALM study, and then a quick recap of the results of the meeting in December. And then we'll dive into the two stress tests that we've run, one using deterministic scenarios and one using a filtering technique on the stochastic projection that we also used back in December. And then we'll wrap it up with a summary of the main findings. So going to the process, back in August, we started discussing the assumptions that feed into the ALM study, especially the capital market assumptions. And using that, we presented in December the outlook and the risks of the portfolio, given the current policies in terms of funding ratio, contributions, and cost of living adjustments. But we also assessed a number of asset allocation analysis that ultimately resulted in two model portfolios, MP1 and MP2. And today we'll zoom in on sensitivity analysis. And there's two reasons for that. So one is we want to assess the impact of various adverse scenarios on teachers and on elders. And that should help answer questions like how resilient are these funds and are the risks acceptable to you? And the second reason is we want to validate the model portfolios that we presented in December do not significantly increase the risks under these scenarios. And hopefully, of course, they actually decrease the risk. So that's the agenda for today. I'll start with a quick recap on the next slide of the results so far. So in December, we found that the fund shows healthy growth to be fully funded in the long term. and this is driven by investment returns primarily, but also by deficit amortizations. Of course, there are also risks, but the risks that we find are not particularly outstanding or different from what we see with peers. So that's good news. The optimizations that we performed show that you can actually further improve the outlook in terms of funding ratio contribution and cost of living adjustments. And combining these insights from the asset allocation quantitative analysis with more qualitative considerations from both Ortec, but also especially Kevin and his team, this led to the construction of the two model portfolios. And model portfolio 1 targets similar level of risks as the current SCA for a higher return. And model portfolio 2 targets a somewhat lower level of risk, with a similar return as the current SCA. And in both of these portfolios, we find more exposure to private equity, infrastructure, credits, and multi-strategy to larger or lesser extents. And then specifically in MP1, there's also the addition of energy, and in MP2, there's the addition of commodities and a higher exposure to investment-grade credits. And in both cases, this comes at the expense of public equity and also a little bit less real estate. Next slide, please. So we now will continue with the first sensitivity analysis using deterministic stress scenarios. Up until this point in the study, we've mostly used the stochastic approach, a probabilistic approach where we use thousands of real-world scenarios. And this is very helpful to assess the risk-return trade-off and to look into the distribution of outcomes. And that allows us to assess probabilities of being fully funded, for instance, or probability of deficit contributions. But now we'll zoom in more on very specific deterministic stress scenarios. And these are narrative driven, and they follow a single coherent economic path from the current market conditions to assess how robust the fund performs under these severe but still plausible economic regimes. And we assess 5 different scenarios over a 5-year period. One is a stagflation scenario, which is characterized by an inflationary cocktail with an equity market crash and higher default risks. And in this scenario, also central banks are assumed to be reluctant to raise rates to spur, to not further hamper growth. A financial repression scenario, which is characterized by low investor and low consumer confidence, where economic activity falls and equity market crash. Here we find low interest rates and high inflation. And then there's the growth-driven inflation, which is a somewhat more optimistic scenario where it's driven by revolutionary innovations, such as, for instance, AI, which leads to productivity growth, high demand, higher wages. And in this case, central banks are presumed to respond with interest rate hikes. Then a deflation scenario, and here we assume that following geopolitical tensions and monetary policies to fight inflation, this leads to an economic shock, again with the effect that investors are reluctant to invest, consumer spending halts, and this causes deflation.
So I have a question.
Tom, there's a question.
I'm sorry. You're saying these are single coherent economic paths. So are you looking at these as 5 separate paths? And if so, are you not looking at where they intersect and correlate to perhaps boost the effect of one over another?
You're correct. There are separate individual scenarios following a very specific narrative about politics, about where the world is headed, and about the economic impacts of that. So from that point of view, they don't interact, and they're really standalone scenarios. That makes it also difficult to attach a probability to one of these scenarios. But they're designed to be realistic in nature and to be able to assess in a very transparent manner how such a scenario can influence the balance sheet in the coming years.
But how one of these might make the other one grow or decline is not reflected in here, right?
Correct. Yeah, they're really autonomous in that regard.
Okay. Thank you.
Trade war is the fifth scenario that we assess, where shocks to the global economic and geopolitical order results in high risk premia. And this in turn causes a sell-off in equities and credits. Assets that do perform well in this scenario are commodities and especially energy, due to the scarcity of these commodities. If we continue to the results.
In the trade
Go
war
ahead.
scenario, are there any material currency implications of that scenario?
And maybe Gilbert, can you help me take that question?
Yes, indeed. So indeed, one of the implications of this scenario is that from a growth perspective, we see a much smaller, but still a hit for the US and Europe, and where Canada and the US are presumed to be hit a little bit harder, and as such also the exchange rate, so the US dollar to devalue a little bit more with respect to the euro, for example.
Modest. Thanks.
Hey, one other question. Is your perspective that these are 2 sigma events or 3 sigma plus events that you're using here?
That's the way we construct these is by filtering on specific targets within the realm of these stochastic scenarios. So maybe for some of the filters, these are 3 sigma events, but maybe for others, these are less kind of extreme events. So it is a combination of filters which we apply. So for example, in a stagflation scenario, the filtering for growth and inflation are more 3 sigma type of events, wherein maybe a trade war scenarios, they're less extreme.
And even though we apply this filtering technique, that is really to design the scenarios in a coherent way for all regions and for all economic variables. Ultimately, we translate that into deterministic pathways, just to avoid any confusion with the second analysis. Thank you. Next slide, please. So here we have the results of the analysis, and if we go from left to right, we start with a base projection, which is a deterministic projection of the stochastic set, followed by the 5 stress scenarios. And then within a scenario from left to right, we follow the current strategic asset allocation, MP1, MP2, and a peer average portfolio. There's 2 main lessons to be learned from this analysis. One, I think, is that the scenario analyzed has a much bigger, more profound impact on the results than the specific investment strategy at hand, or at least of the portfolios analyzed. And 2, if we look within a stress scenario, we find that MP1 and MP2 perform similar or better than the current SA or the peer portfolios. So then it's also good news as well, of course, as this validates the performance of these scenarios, not only within the stochastic projection, but also under these adverse scenarios. Then specifically for MP1, we find that this is more resilient in growth-driven inflation scenarios and the trade war scenario. And that is mostly thanks to the private equity and real assets in there. Credits and private infrastructure. For model portfolio 2, we find that this performs good in most other scenarios, and maybe less so in the growth-driven inflation scenario, but good in the others. And that is thanks to a greater allocation to investment-grade credits, multi-strategy, and commodities, while at the same time a lower allocation to public and private equity, and also no energy. And so this basically validates that these portfolios perform reasonably well under these adverse scenarios. Are there any? And on the next slide, we show the results in terms of contribution, employer contribution, and ultimate net cost. I'll pause now to see if there are any questions on this section.
Not quick question. How would I think about, and this may tie into the next section you're about to talk about, how would we think about the scenario that Citrini Research just outlined? Which, yes, is extreme, but is still helpful for thought, you know.
Sorry, could you repeat? I couldn't fully hear how this compares to.
To the research that Centrini just put out on Sunday night, which is an extreme scenario as it relates to AI.
We'll call it the AI dystopia scenario.
Yeah, that's a better way to say it.
Yeah. So these scenarios that we presented today are based around specific narratives. If we look at the economic implications of these scenarios, that is to a large extent still covering a wide area of different economic pathways that the economy can take, whatever the root cause for that. So that can also be indeed the result of this this more dystopian AI pathway. Depending on the specifics of such a scenario and the assumptions, it would align maybe more with a stagflation scenario, or a financial repression scenario. I don't know, Gilbert or Patrick, if you would like to add anything to that.
Yes, so there's multiple dimensions in which you can construct such a scenario. The most, I think, like the Bridgewater ones, where you look at the axis of inflation and growth or economic growth, but there's of course multiple things that you can create such a scenario on. So it says, what will interest rates or policy rates do in such a scenario? So there are many flavors. We have 5 of them. You could think of an AI dystopian scenario as a low growth, low inflation scenario, but there's also multiple flavors in what that could entail. So maybe, like Tom mentioned, it is maybe closer to a stagflation scenario.
In any case, it's something that we keep a close watch on, and it can be food for thought to further adjust or add stress scenarios. But at this point, we feel that the ones that we have sufficiently covers the broad realm of where the economy can grow to. Next slide, please. Next. So in addition to using deterministic stress scenarios, we've also applied a filtering technique to assess the 4 far ends of the economic quadrant, defined by growth and inflation. So for this analysis, we go back to the stochastic projection and apply a filtering technique described on the next slide. For reasons of maximum impact, we've decided to filter on and to zoom in on portfolio returns instead of growth. So we use returns as a proxy for growth. And we filter on 2 conditions simultaneously, one being portfolio return and the other being inflation, to find the 4 quadrants of the economic quadrant. And then we evaluate these conditions in the 5th year of the projection. In each of these cases, we find roughly between 50 and 100 different scenarios. So that's sufficient for further statistical analysis. And we compare these results again to the baseline expectations on the next slide. So consistent with the deterministic projections, we find that a low growth, high inflation scenario hurts the most. That's the blue lines here, the blue bar charts. And losses are largely driven by the exposure to both public and private equity. That's where it hurts the most. We also find that growth itself, higher or lower growth, has a higher or bigger impact than higher or lower inflation. And this is probably straightforward, as you may be well aware that the amplitude of the returns is of course larger than the amplitude of inflation. We also find that for model portfolio 2, this performs relatively well in a low growth scenario due to the lower exposure to both public and private equities and a higher exposure to investment grade credits. So it's a little bit more robust to low growth scenarios. And MP1 performs well in high growth scenarios, precisely due to those higher exposures to private equity, but also energy and infrastructure. Then On the next slide, we have these results also for the employer contributions and ultimate net cost. Are there any questions on the results?
Can I ask a question? When you're modeling the high inflation scenarios, does it assume a central bank reaction to high inflation in the form of higher interest rates, which then results in higher cap rates and lower discounted, cash flows, lower valuations as a result of higher cap rates? So do you assume a reaction by central banks due to high inflation?
That's a good question. It depends a little bit on what exactly we're looking at. And so for the deterministic scenarios, the answer is mostly yes, because there we're zooming in on these very specific narratives, indeed, where we also assume a reaction of central banks on the economic conditions. So there, this definitely plays a role. For the stochastic modeling, where we have thousands of scenarios, this isn't explicitly defined in each scenario, but there is an implicit reaction, of course. And all these to the extent that this behavior is also present in historical data, where you can observe responses and correlations between inflations and valuations. That is also captured by our models and thereby present in our economic scenarios. So through that mechanism, this is broadly captured as well. I don't know, Gilbert or Patrick, if you'd like to add anything.
I could maybe add, indeed, like Tom mentioned, if you look at a specific scenario out of this scenario cloud of multiple thousands of scenarios, it doesn't necessarily have to hold for each scenario. But if you look at a correlation behavior of all of them together, we do have these stylized effects where correlation between inflation and policy rates is positive. So yes, on the broad base of scenarios, you will see this behavior come back in the scenarios.
Okay.
So from our presentation perspective, I get you have to kind of show kind of spot or kind of singular kind of numbers for the returns and the expected funding ratios. Was there anything unique in the distributions or anything on that side that, from your modeling, were there any distributions that were wider or skewed one way or the other?
Sorry, is that in, could you please clarify, do you mean with respect to the ALM metrics or more so the economic scenarios?
More so in respect to the geometric return and funding ratio outcomes.
So for the returns, they are skewed to the downside. So risks are larger than upside risks, so to say. With the funding ratio, it's a little bit the inverse, where downside risk is limited by the deficit contributions. And so funding ratio can only go so low before the deficit contributions kick in and have an upwards effect. Well, on the upside, at some point, once the funding ratio exceeds 100%, you could basically translate that to investing with leverage. And we find that in certain scenarios, the funding ratio can really skyrocket in the long run. That also has to do with the fact that we have modeled deficit amortizations and we have modeled conditional cost of living adjustments. We haven't modeled perhaps a response of the board on very high funding ratio scenarios. Would that answer your question?
It does. I'm sure it varies between the various scenarios. I was somewhat curious if any scenario was more skewed than another scenario, but that's we can take that offline. That's fine.
Thank you.
Would you like to summarize?
Yeah. we go to slide 22. So to summarize, we find that the fund shows healthy growth to being fully funded in the long term. Downside risks are moderate, but can result, of course, in lower funding ratios and high contributions. Then we find that the two model portfolios can further improve this outlook, especially in terms of ALM metrics. And we also find that in these stress scenarios analyzed, MP1 and MP2 are robust portfolios. They perform similar or better in most cases than the SAA or the peer group average portfolio. MP1 is a more slightly aggressive portfolio than MP2, targeting a higher return. On a 5-year horizon, the additional risks of MP1 over MP2 seems manageable. And we find that in the long run, this portfolio also achieves a better outcome in the central expectation. Now, this does come at the cost of higher risks, but given that you're starting at a position of underfunding, these risks are being outweighed by the additional return that is being generated with MP1, which overall reduces the size and the probability of the deficit contributions. One point of attention maybe then is the illiquidity scoring. So that's assessed to be around 37% for MP1 and 30% for MP2. So for MP1, you are closer to the 40% limit. And taking into account market swings, of course, that means that this will need to be monitored more closely. Overall, I think both MP1 and MP2 are very strong portfolios that can improve an already good outlook while keeping risks manageable. Post ALM, this is something that can further be monitored using the Navigator report that we will deliver on a quarterly basis, which contains the same forward-looking ALM risk metrics as we have shown in this ALM study. So we'll continue to support you with that through the Navigator report. This concludes the presentation. If there are any questions, I'm happy to take them.
I have a question. As I'm looking at this, there doesn't seem to be anything that's screaming out that MP1 or 2 are significantly better than the SAA. I mean, there are places where each of them are perhaps somewhat better. It looks like it's not sort of on the margin, but not that significantly. Would you say that's a fair statement, or I'm looking at graphs which have large y-axis, so it's a little hard to say.
Yeah, I can see why that's the first impression, and especially I think when you look at these stress scenarios, the differences may seem relatively small. That's mostly based by the fact that a specific scenario will have a more profound impact than the difference in portfolios that we have assessed. That being said, if we look at the longer term and if we look at the outcomes of the stochastic projection, we find that in the central expectation, so for instance, the median funding ratio, MP1 improves the funding ratio in year 20 by about 7 percentage points. So instead of being at around 99% funding ratio, you achieve 106% funding ratio. And at the same time, the risks remain very similar. So from that point of view, I do think that there's a significant gain to be made by tweaking the portfolio in the long run.
Okay, thank you.
The other point I might make as well is that one of the things that's going on underneath the ALM is that we're now allocating to asset classes which have much higher alpha potential going forward, and we assume 0 from alpha. That is not the goal.
Exactly. I would comment, though, that I can't think of an asset liability study I've done over 30 years, the past 30 years, where somebody doesn't say, this was worth all this effort, because it's always on the margin. And it's the size of the asset pool and then the length of the horizon where it really matters. That's where the compounding effect happens. So you know, from a technical standpoint, it's like we have the potential to add another 50 basis points per year, right? In the world of active management, that's not that exciting, but on our asset size and then the potential to add alpha on top of that 50 basis points is really where it makes a difference.
It could be both ways, because on the other hand, it's kind of like what we've got planned in the asset allocation is not terrible, you know. So, okay. And I'm not saying we shouldn't change it. I'm just saying that it's kind of nice to know that we're sort of in the ballpark. I mean, I actually am always an MP1 kind of person, so.
Yeah.
Glad that's the way it came out, but I also feel comfortable that we're not in a bad shape if we are right now. Looks to me like.
And that SAA was changed
I know.
14 months ago.
I know, and that's a very good point to make. That's how it had been 2 years ago. It would have been very
Yes.
different.
And I think if you go to the appendix and you look over 20 years, to Kevin's point, I mean, that's where you're really seeing the numbers.
Yeah, I like looking at the ultimate net cost. The difference between SAA and MP1 over 20 years is $17 billion. What's it in dollar terms, right?
Matters. It's roughly what we collect as a state income taxes every year. Just to put it in context.
Any final questions? If not, I'm good to move on to the next agenda item, which is to do an overview of changes to the investment policy statement for the retirement systems and talk about the proposed methodology for the liquidity scoring, as well as the transition plan, how we're thinking about that. Within this, there'll be effectively an approval item to approve the investment policy statement, this liquidity methodology that we're recommending, as well as the transition plan. So in terms of the investment policy statement, I'll just hit the highlights. The investment objectives are a bit simplified relative to what we had before, but they're very focused on kind of our core mission, which is for the retirement systems. We want to contribute to that objective of being fully funded and to achieve and maintain that over the long period of time. That means we need to produce a return that's fairly close, hopefully in excess of 6.5%. That's actual assumed investment return. I'll come back to that in a second. And then on the risk management side, it's really to stay within this absolute risk operating range, which we're defining in terms of the equity bond split, the debt split, which shows up in the strategic asset allocation. We want to beat our benchmarks. Then obviously part of performance is maintaining compliance with all of our statutes, regulations, our fiduciary obligations, and so on. So the strategic asset allocation that we're showing and recommending is this MP1 that we've talked about last couple of meetings and just now. We're defining the strategic asset allocation at a much higher level, equity, debt, and multi-strategy. So it's effectively the 65-35% allocation overall that we modeled in MP1. And then we have targets and ranges at one level below, so corporate equity, real asset equity, and then the major subcomponents within debt. And then if you go to the level below that, we're not setting targets for public equity, private equity, real estate, infra, and natural resources. And within the IPS, you'll see that we're really encouraging, particularly in corporate equity, I'll use them as an example, that we need to access deal flow commonly through our relationships with public equity managers, private equity managers, and even hedge funds to a certain extent, that everyone is working in similar kind of markets with different vehicles, different structures, but we really want to amplify that deal flow and the access and the ability to underwrite from different perspectives. So that's what this allows. It also allows us to transition away from our current strategic asset allocation to where we want to end up, which MP1 is an example, but we don't know what the markets are going to bring us as we go forward. So we want to have that flexibility. We think this will also help avoid some of the inadvertent bucket filling that some organizations pursue with very definitive pacing plans, and that can lead to over diversification. It can lead to performance degradation. So we want to avoid that as much as we can. On the risk management framework, most of this is straightforward. I have a panel of parameters coming up on the risk budget, so won't get that. On the rebalancing, it's plus or minus the policy allocations for rebalancing, which we handle at the investment committee level. If we ever go outside of those broad ranges that are set out in the investment policy statement, and we're out for more than 1% for more than 4 weeks, we have to come to the board. So we would give you notification, obviously, when we went outside, but we can't stay outside those ranges. We need to have that discipline. But of course, at that moment in time, that would just be a fiduciary decision that the board would take on as to whether they wanted us to go back inside the range or not. Then on the controls, liquidity, come back to that. Cost effectiveness, we haven't brought our third-party analysis yet. We'll do that probably later this year on all the aspects of the investment program, staffing, manager fees, expenses. That's all benchmarked by a third party. So we'll bring that later this year. And then the asset liability studies, good news, bad news, we'll do those every 1 to 3 years. In the meantime, we do have this quarterly capability that Ortec will support us on to look at these portfolios, re-optimize under more narrow constraints. So as markets move, we can see kind of what the model at least would recommend around course correction and emphasis. The benchmarks have been reprioritized. So the leading benchmark is now the actuarial rate of return, the 6.5%, again, tied to our primary investment objective, which is to help with keep the plans well-funded and hopefully fully funded. And then the reference portfolio, which measures all the active bets and positions that are taken away from just straight passive public equities and intermediate duration U.S. Treasuries, which is kind of the risk-free rate for a pension fund. And then the implementation benchmark, which is typical for virtually all public pension funds, corporate plans as well. There, we're asking that gets delegated to management. We'll use floating weights during the transition because we're pretty far away from some of the targets. And what we want to do is choose some industry standard benchmarks, avoid customization. And we would come back in May with a white paper to show you the selection of the asset class level benchmarks, the methodology, pros and cons. But ultimately, we would just manage that at the kind of the team level, and you'd have visibility. You'd see it in the quarterly reporting, and then to the extent we change that benchmark, that would be well known as well. The risk budget. So this covers a lot of the parameters that we would be monitoring over time. So we have risk systems that look in the rearview mirror. We have realized risk, and then we can also kind of look at the current portfolio and what the risk predictions are. So we'll do that with a mosaic approach and report on that each quarter.
Kevin, can I ask you a question on that page? Functionally, so the volatility over 3 years should typically, definitionally, should be higher than the 10-year volatility. So that was kind of odd. But like, what happens if, like, it doesn't make a difference. It's fine if it's 12, right? But what's like the procedurally?
Yeah.
Like, how does this stuff work?
So I think of it in on your volatility. Yeah, we agree. This is a function of kind of broader ranges, but you're right. Over 10 years, you should get this kind of time diversification effect for the range of outcomes. They cancel out, right, over longer horizons. In terms of the process, we'll have a management level risk budget, risk management policy. I think about it as like red, amber, green. So if we're well inside these expected ranges, that's green. As we get to the outer bounds on either end, then that's amber. If we go outside, that's red, right? And then the process should be that as we go into amber and certainly red, that we go back through the risk team to do the kind of risk factor analysis of what's driving us to be outside those ranges. Then the investment side, the portfolio management side connects in with that as well because they're closer to the portfolio. And what we need to do at both the management level and ultimately to the board is accept that level of risk or not, right? So sometimes there's a trade-off. So if you go to post-COVID, everybody's risk went quite high for a short period of time. Tracking error budgets got blown up. But for some plans, the value add went up also. And so the return on that risk, measured by risk-adjusted returns like information ratios, for some went quite high. So I found myself at a prior organization arguing, we recommend keeping the risk level where it's at. We don't recommend moving assets to de-risk because our information ratio is extremely high and we're comfortable with our manager's approach to managing through this environment, right? So that's a good position to be in. Again, I'll just use my own experience. Other times in my career, it necessarily wasn't that way, right? The risks went up massively. There was no clear return on that risk. And so then we escalated, we went a different route, we restructured. Just some risks we just needed to extinguish and some workouts and things like that. So that's the way I think of the process. But obviously, quarterly, the board will see this and we're always open to input and redirection as well.
And if I could add, the 3-year number and 5-year number here represent kind of a transition from the current asset allocation to the MP1. So we have a lower risk portfolio now than we will in the long term. So that's explaining part of that gradation to higher risk.
Other questions on this? Okay. For the guidelines here, I'll just emphasize a couple of qualitative things. The two at the top, competition for capital. So again, we're trying to drive this through our investment committee process. Everybody's at the table. Everybody sees the pipeline. We know what the performers are and basically have an ability to understand where the risk exposures are and whether we're getting compensated. We expect to get compensated for the levels of risk. So that'll happen through the investment committee. Diversification, again, what we're trying to drive is we're very well diversified on the public market side. We don't need to be diversified, and it kind of works against our objectives if we're over diversified within our private markets. So as you've seen in our pipeline, we want to concentrate our private market relationships. We want idiosyncratic risk. We want general partners who can navigate complexity, add value through operational improvements, depending on asset classes, or have trading skill. And so we need to have that be concentrated. If we over diversify, it just waters it all down, and we will fundamentally just have a big market portfolio with fees on top of it. So I think that's a big part of what we need to do going forward. We do expect, and we'll talk about this in May, expanding our internal management and where we'll focus our time and energy there. But that's an ongoing set of activities. So if it's okay, I'll talk about the scoring on liquidity. So what we're proposing is that we'll measure liquidity over 4 horizons: 3 months, 6 months, 1 year, and 2 years. And then we'll monitor 2 scenarios, a baseline and a stress scenario. So the baseline is just instantaneous pricing on the portfolio around how much liquidity we have, and I'll show the assumptions in a second. So you measure it at time zero liquidity. The stress scenario, it's still time zero, but we're assuming 2022 happens instantaneously. And we think that's a very good conservative scenario for measuring liquidity, because both public equities and fixed income sold off pretty notably because of the rise in interest rates. And so then on top of that, we'll stretch out some of the liquidation timelines, so less liquidity, and then we'll accelerate some of the capital calls that in the real world, when there's market stress, the bid ask gets so wide that you don't get much activity. But we think, again, to be conservative and to look forward, we can accelerate some of the capital calls. Okay. So these are the assumptions by asset class. Essentially, on the public side, first 3 bullet points: very ready liquidity within equities, public investment grade, fixed income, and commodities. The open-ended funds, our thinking is we'll look at the redemption rights They're very specific to each fund, whether there's investor gates or fund level gates. Closed-end vehicles, what we're assuming is that about a quarter of our portfolio, you can think of private equity, would be readily liquid in the secondary market within 9 months. And so a quarter of our private equity portfolio would be sold in 9 months. And then the haircut that we give up would be determined by what we get from our kind of the intermediaries of the world who follow pricing for private equity funds, LBO, venture capital, real estate, infrastructure, and so on. And then in the limit, half of that portfolio or any of these closed-end vehicles, we assume are just not liquid within 2 years, which again is quite conservative because the secondary market is growing enough that you can take most things to the secondary market. High control structures are mostly real estate. We have some on the debt side as well, but notably the idea here is these were set up typically as customized, separately managed accounts. We think we can take about a quarter of that within 6 months, sell the properties for a 20% discount, and then you can see the schedule going out. So what we would recommend is that as a pension fund, a 2-year window is more appropriate given our circumstances to measure illiquidity, or what's liquid. It's just a mirror image. And we have pretty strong predictability around our external cash flow needs because contribution rates are set in essence 2 years in advance. The retirement system's payroll, which is what the contributions are applied against for both employers and the employee contribution, don't move that much. And net benefit payments, so it's benefit payments less the contributions that are coming in, are only about 3% of the plan. So there's not that much of a burden in terms of liquidity. So we recommend that you look at how much liquidity or how much cannot be sourced over this 2-year window, given these types of assumptions, which again, we're happy to tweak the assumptions. And we would come to the board quarterly, show the baseline, show the stress scenario. So again, the baseline can look comfortable, the stress might not be so comfortable, in which case then we can take direction as to how you feel about that. So I'll pause there on that.
Hey, Kevin, quick, the legislation just requires the baseline, the 40%, right?
Exactly. Yeah. Yeah. And I guess the way I think about it intuitively is that there's a lot of crises that have occurred over time that seem very sudden, right? And so you're pre-crisis, and then you're in crisis, and then you're post-crisis, right? And when you're in crisis, we don't want to be having conversations with y'all to say, oh, last quarter looked wonderful, now it's horrible. And it should not be any shock, right? So that's the idea of doing the stress scenario, and try to keep that in line of sight, that there can be exogenous events or things that catch fire in the markets and economies that suddenly change liquidity conditions. So we just want the board to always be aware.
Kevin, I think I asked this question. I apologize that I don't recall. In the stress scenario, that 3% number you cited, are there hardship withdrawals, or is there anything that the participants can do to ask for more money when you find yourself in that situation, or do we're not exposed to that?
Not really.
Okay.
No, I mean, what can happen is there can be like a rise in retirements, right? That could happen. For the 2 primary retirement systems that, we're managing in this pool, is such a large diversified base of employees that are covered or beneficiaries and in active retirement. So I don't view that as a big risk. I think if it was a smaller plan or a single employer plan, that's different. Then you could have circumstances change, rationalizations, things like that.
Partial withdrawals. Full refund, lost entire account, or if they retire, distribution. That's the.
Right, if you had an en masse reduction in force of state government and you had huge requests for withdrawal, which only before a certain number of years before that made sense to do. That would be the biggest potential liquidity out. That's a pretty extreme scenario.
Okay. So I'll talk about the transition plan. And again, this is pretty high level. So we have a long road to go in terms of the transition. The thing I want to highlight are what I've put in these golden boxes, which is where we have kind of notable overweights and underweights. So this is the new structure under the strategic asset allocation we've been discussing just now. And we've sorted tentatively all of our existing investments into these new categories. There'll be a little bit of movement still before we tie this down. But the notable difference here that makes me a bit uncomfortable is we're almost 5% underweight in the equity category. Notably, that's coming from real asset equity. And so if we were to go to the target, that would be $13 billion that we're underweight. So again, not to contradict my earlier comments about bucket filling, right? But nonetheless, this 5% underweight to me gives me pause given our outlook, which again is constructive around basic economic growth, profit growth, a lot of investment, and a mismatch of capital, particularly in the infra space. So what we're thinking about and recommending for our transition plan is that, like I mentioned earlier, we have about 12 billion in the forward calendar. Some of those will fall out. We won't close. The underwriting will reject the investments later in the process. But these are high conviction investments. They're material individually in size. So that will be one of the primary ways over the next 12 to 18 months that we close the gap as reasonable. But then to mitigate that risk of the equity underweight and the fact that it will take us 12 to 18 months to work through this forward calendar, we would like to address that equity underweight by funding some liquid vehicles, which would be global REITs, listed infra, some natural resources equity. We use this terminology of staging portfolios, that it gets us basic exposure. It's not exactly the same as what we want to end up with eventually. And most of these, not all, natural resources can be quite volatile, but the others, there is some public equity exposure, but it's a beta that's lower. So we think this is a reasonable way. And then we would source the liquidity, which we're sizing up as 4 to 8 billion from all cash, public equities. We'll pull some money out of there. We have some legacy portfolios that just don't fit in the new structure. They're liquid, high quality, most typically asset-backed investment mandates. And then we're doing this rotation, as Ron mentioned, within credit. So we would use those monies. To put it in context, 4 to 8 billion, again, doesn't necessarily close that real asset equity gap. That's not our goal. But we do want to bring the risk down of being underweight in the broader equity portfolio. And then we would suspend our rebalancing for 6 months. We handle that at the investment committee just while we deploy and we get closer. And then as we feel we're close enough and the board would have visibility to this quarterly, we would call that over at some point and then start to rebalance again. So I will stop there. Happy to answer questions. We're looking for approval of the investment policy statement for this liquidity measurement methodology, and then also for this transition plan, which give us authority to move 4 to 8 billion into these liquid staging portfolios. That's the ask.
I'll just make a couple quick comments, Kevin. So I think the liquidity is very well thought out. As you know, if you look at any 2 sigma event in the markets over the last 150 years, 2 years is about peak to trough to recovery. 3 sigma events, there's only been 4 of them. Like, so you can't, it's a very good balance you've struck there related to that. In the downside, I would encourage you to apply a discount on the illiquidity. Like the price you can get in the downside is going to be cheaper, lower than on paper, because we all know just So I think it's, but I think it's very well thought of. The transition plan is fine, and I know you're already doing this, you all. It's always, transitions are difficult. You just want to be mindful of friction cost and not to do things to do them, right? You see a lot of folks, it's tough, right? But you do the best you can during these time periods.
So to that end, we talked a little bit about active versus passive with respect to the transition plan. Have you thought any more about whether or not you're going to try to zero out some of the friction or noise if you were trying to get into an active strategy and fees relative to just putting the exposure on passively and then moving it once you get the investment funded?
Yeah, we don't have a strong bias at the moment. I think passive exposure is straightforward. It's also more liquid, right? Particularly if we utilize one of our existing relationships that has a lot of scale in the passive side, BlackRock, and then they can cross at the fund. So it addresses the fund level, the module level. So it addresses some of Dan's comment. I think we're less certain would be around like natural resources equity, because we have particular views about what exposures we want to have coming out the back end, right? And so that we might not do passive, but there are other tools, right? So ETFs as an example, including customized ETFs, which is something that can be done with significant cost savings, and then it can be targeted, still passive.
Yeah.
So we have a pretty good toolkit, and we have relationships as well. We don't trade derivatives internally, right? That's something that is to be developed over time. But we have external relationships that can utilize derivatives subject to our oversight and guidelines and all the controls. So that's also helpful.
The one last question, because it was related to that too, given Ty's comments, just in precious metals, if you've thought about being more targeted there in the environment
But
on an index basis.
Yeah, we've definitely had discussions months ago around whether we should take a gold position or not. We have a small footprint in public commodities, just broadly diversified, which is more energy. We don't have a view at the moment on how we're going to deal with precious metals in this transition, just to be frank. Yeah. Okay. That's it for me.
So unless there's other discussion, I need a motion to approve the resolution of Board of Directors to approve the proposed NCRS investment policy statement inclusive of the recommended liquidity scoring metric for statutory compliance in the transition as presented by the North Carolina Investment Authority.
I'll move it.
And second. Call the roll, please.
Ms. Shipping Russell,
Aye.
Mr. Ward,
Yes.
Treasurer Brunner.
Yes. Okay. Thank you. Let's move on to AgVIP investment policy statement. Back to you, Kevin.
Yeah, so this is predominantly a cleanup of an existing investment policy statement for our smallest mandate. Chris is going to go through the recommended changes and give some background on the program as well. So there's a good grounding, but go ahead, Chris.
Yeah, sure. So the investment policy statement, the recommended investment policy statement was located in your materials. And yeah, after we go through this, I'll give a highlight of what AgPIP is, and then highlight what's in the IPS, and then we'll ask for approval for that. So the Ancillary Governmental Participants Investment Program, which is a mouthful, we call AgPIP. It's an investment program that for governmental entities, mainly outside of NCRS. This program began about 20 years ago with the purpose of allowing certain entities, certain governmental entities within North Carolina to invest long-term assets through the state treasurer's office. The types of investments allowed are limited by statute. Through the Modernization Act last year, the investment authority for AgPIP has transferred over to NCIA, where we act as fiduciary for the program. We're fiduciaries for the selection and oversight of the external managers, the management of internally managed investment options, as well as the investment oversight and are responsible for the asset allocation for certain specific participants within that. So in general, the participants that are part of AgPIP, there's really two categories. There's what we call mandatory participants, which are the ones where NCIA has the oversight of the asset allocation. The three main ones are listed here: the disability income plan, a sheep fund, and then the register of deeds supplemental pension fund. The majority of the participants, and I'll go into some more details on the next slide around how many there are, but they're discretionary participants that are voluntary. So they choose to join. They're the ones that are responsible for selecting the specific investments, for selecting the asset allocation. And again, what they're authorized to invest in is specifically authorized within statute. So if you go to the next slide, please. So on the top right here, you can see the participants, a summary of participants. Currently, there are 78 participants in the program, spread among different types of entities such as OPEB trusts, state agencies, the OSA trusts, among other types of entities. And this program has continued to grow over time. 10 years ago, we had about 40 participants. 5 years ago, there were 57 participants, and currently 78. So it has grown over time. Total AUM of the program is currently just south of 3.4 billion. The top left pie chart here shows the allocation by investment type. I'll go through specifically what those three are on the next slide. And then the investment allocation by type of entity you can see on the bottom here.
One comment, and this goes to the next slide. We don't market. This is a program that we provide. The demand comes from essentially the General Assembly to give these types of participants the opportunity to invest in these low-cost products. We don't admittedly have a high service, a high touch approach at all. We keep it very simple, low cost, and that's the benefit that the clients get out of it. We'll get indications of interest, inquiries. NCI staff answers those questions. We sit with folks. Used to periodically do meetings with some of the investors if they had questions, and if they wanted us to come to a board meeting or something like that. But really, this is something we do as just an extension. It's like an adjacent set of products that work for us, works for the participants, and serves what the General Assembly would like to have done.
Allows them to get market exposure.
I mean, what is PIF, EIF?
I'm going to go into that on the next slide. Sorry. So we have three investment options. They're all passively managed. We have our short-term investment fund, so the STIF fund that Jeff and his team manage, that is part of the larger cash management program. We have our bond investment fund, which is the BIF. That is essentially a Bloomberg U.S. aggregate bond passive index fund that BlackRock manages on our behalf. And then we have what we call the equity index fund, so the EIF, and that's passive global equities. So BlackRock manages that as well, and that replicates the MSCI All Country World Index.
The fee levels for the BlackRock products are roughly
2 basis points or less. I think it's 2 on the fixed and
2 on the equity, a blend of 2.5 on the fixed, depending on AUM.
No additional fee from MCI.
No, not at this point, although when we come in May with recommended administrative fees, this is an area that we need to have some recapture of cost. Yeah.
So by statute, we have the ability to charge administrative fees. Never done that in the past, but.
So it's just a pass-through currently, and then we'll think about resource allocation by same teams doing it.
Yes, exactly. Absolutely.
Yeah.
Yep. So these are the 3 investment options. Like I said, they're all passively managed and are pretty much on our side in terms of how to.
One small tweak, because Brett, his head's going to explode if we say that his product is passive.
Yeah.
It's not entirely passive.
Let's lie, but.
Let me make sure I heard correctly. So several of these select their own asset allocation in these. And what is the entry exit time frame?
So the way we run it, it's a monthly process. So they have the ability to deposit and withdraw on a monthly basis.
In practicality, what is the
rebalance that they do?
Each one has their own process for that. And again, it's hard for us to opine on that because we don't know.
Is it high transaction, low transaction?
It's low. Some.
Well, 5 to 10 transactions.
Yeah, it is. There's 78 of them. We see more activity from certain counties and certain participants, but mostly they're depositing additional monthly as they get more cash flows. Like we see certain counties, I think Mecklenburg County is one of the largest participants in that. And we see more activity on those, but yeah, it's not a lot. And we've, set this up as a monthly liquidity vehicle for one of the reasons for that.
And they have notice period, I would assume. They have to notice you for.
Yeah, so we have a whole process around that, 5 business days ahead of time, because we have to place the trades with BlackRock period of time and all that. So we have a whole formalized process around that, which is all on our website. And we go through that process when setting up any new client to make sure they understand that.
Just one clarifying question on the NCIA bar that has 4 of the participant types. Am I to assume that's the disability income plan, the register of deeds, the ones that are?
It is. Yes.
Mandated by statute to do, and there's one more in there, which is fine.
Yes.
Okay.
Yes.
I was just trying to connect those dots.
Yep, that's correct.
We also, just a note on these participants that are self-directed, it's very explicit in all of our documents and any communications that we're not going to take any advisory role around asset allocation. That's just not part of our mandate. And that's where all the risk is, right? For all intents and purposes for a lot of these investors. So we're happy to help and have discussions, but we're not going to advise. And that's clear when they sign up. We have part of the restructuring we did a number of years ago was to put in place really strong onboarding documents, disclosures, grantor trusts, to make sure that this is all institutional from that standpoint.
That's the service side where you might still have a bit of an exposure regardless, just speaking from experience and running some pools. So making sure, especially if we're going to consider a fee associated with it, just thinking in terms of how we might bolster that a bit.
Yes, yes.
It's legally, obviously, their responsibility, but perception is.
Okay, so those are the investment options. One more slide to hit. So this gives the oversight activities and the responsibilities of the board and the CIO is laid out in the IPS. So the board's responsibility is very similar to NCRS, including policy and governance oversight, certain investment oversight, review of performance and effectiveness of the program, and then review of audit financials and other independent evaluations. The CIO's oversight, CIO is delegated for policy and strategy development, including changes to this policy and establishment of program objectives, operations and risk management, including oversight of NCIA operations and key reporting metrics associated with that. And then the CIO also has the authority to choose investment managers and investment vehicles for the program, as long as they meet the defined investment objectives and applicable statutes.
Yeah. So in essence, if we wanted to move away from BlackRock, we wanted to take Brett's portfolio away and give it to an outside money manager or the custodian. We might do that on a short-term basis. But if we were to add a 4th product, that wouldn't happen. That has to come here. The board has to be comfortable with that. And that has come up periodically over time. Why not have a longer duration or an even shorter intermediate bond product, depending on the interest rate cycle, things like that. So, but that would be almost like a defined contribution lineup redesign, and that would require an amendment to the IPS. We'd come to the board for that.
So that concludes the slides I have prepared. So happy to answer any other questions.
Okay, I will now accept a motion and a second to approve the resolution of the Board of Directors to approve the proposed AgPIP investment policy statement as presented by the North Carolina Investment Authority.
So moved.
Thank you. Second. All right. Call the roll, please.
Mr. Roberts.
Aye.
Ms. Lynch. Treasurer Runner.
Aye. Okay. Let's move on to Mark Lord.
We take a small break.
We can do that. Let's take a 5-minute break. Reconvene at 11:05.
Motion to recess.
The motion to recess, please. All right, well, a motion to recess for 5 minutes. All right.
Sally should move it.
Right, can I have a motion to reopen the meeting? So moved. Second. All right. We'll do that by voice vote. All in favor, aye. Aye. All right, we are unanimous and we are reopened. And now we will turn to our friends at Mercer here for the market-oriented compensation plan.
Thank you so much. And thank you everyone for all of the time that the board has put into helping guide the process. Josh wanted me to apologize. He's actually in Georgia, so we'll have to get them to better coordinate their meetings so they aren't at the exact same time on the exact same date.
Now we know who he likes better.
And I have my colleague Grant Hallman here as well as my colleague CC Gruber, who's in the back of the room. So the agenda of what we want to go through today is the interview themes of what we heard from the board during the interview phase of our process. Then we want to go through the incentive plan design and recommendations coming out of this process. We do have some cost modeling associated with the recommended incentive plan design. And then we can talk about questions all along the way and next steps.
So I'll start off by touching on these interview themes. So this first slide just gives an overview of who we talked to and who the participants were as we go through the themes, as well as the topics that we covered. So incentive plan eligibility, incentive plan design, and then incentive plan administration. So we move over to the next slide and we go through the several topics. So there's eligibility, target award levels, metrics and weights, measurement period, leveraging caps, payout timing, deferrals, and administration. So we covered a good amount of topics as we've gone through these interviews. We've been very thorough in this process. So we, first start off with the eligibility. Most interview participants supported the inclusion of all roles that will be a part of NCIA. So that's including the non-investment roles, your front office, middle office, back office. And for the main purpose of that is to make sure that everybody is aligned and moving in the same direction. As you start off in creating a new agency or organization, you want to make sure that culture is developed where everybody feels like they play a part in the success of the organization. The excluded participants in this would be any of the shared state treasurer's office roles. They would not be included since they are not exclusively part of the NCIA. As we go into the target award levels, we have based the target incentive awards at the market median 50th percentile, so making sure it is competitive. As well as for the non-investment roles, they have a lower target than the direct investment roles. So going into the metrics and weighting, there was a strong preference on total fund performance as the primary metric and measured against the actual rate of return and the appropriate benchmarks. The asset class focus roles would have an asset class benchmark included in either their financial or individual performance. And then a scaled qualitative or individual metric should be included, which is scaled for different roles throughout the organization. As we look at the measurement period, using a 3-year rolling measurement period was the primary standard that is preferred, with optional 5-year checks for asset classes. It was also recommended to scale as we get the additional, as we start off to get the years of data in order to have like a 2/3 payout until we have a full 3-year set available. And the consensus is to use a calendar year for the measurement period rather than a fiscal year. And then also to phase in new hires, which we'll talk in a little bit later. In terms of the leverage and caps, there was a preference for a modest market cut-in, scale payouts to caps. So we talked about whether we would do 150% to 200%, and then ensure that there was meaningful active performance. And then in terms of payouts and deferrals as well, pay on a calendar year schedule with a multi-year deferral component, which we invested back into the fund, as well as looking into legal implications of that as well. And then from an administrative standpoint, set clear, simple rules for termination/retirement payout scenarios, allow limited board discretion with the guardrails, and then also define what we're going to do in a down market in terms of the logic of that.
So let's go through each of the different elements in a little bit more depth of coming off of all the feedback that we received. what the recommended plan design is. So here you can see on the screen and on the page, the front office opportunities. As Grant mentioned, the incentive targets are aligned with the market median. And so for the different roles within the front office team, the recommended cap under the plan is 150% of target. I would say that's a relatively conservative approach in these types of plans. We usually see 150 to 200% of target on the top end. We think that this is an appropriate place to start with a plan and a good approach given the feedback that we received from the board. On the next page, we have the recommended opportunities for the middle and back office. You will notice that these opportunities are lower. In the market, we do see these roles often participate in the plan, especially in situations where you want everyone to be rowing in the same direction. But the market opportunities are somewhat lower. And so that is reflected here. But these roles would also have an upside of 150% of target under the plan. Here we talk about metrics and weighting. And so through our conversations, it was determined certainly want to have a large emphasis on the achievement of financial metrics, as well as there are individual and qualitative items that are important to each role, especially as you're stepping up and standing up an organization. There are some things that you really do need your team to be doing that maybe won't be measured under one of these organization-wide metrics. So the financial metrics would range from 60 to 80% of the total opportunity. As you can see in the chart below, for the chief investment officer, 80% of the opportunity would be based on financial performance metrics. And we find that that is very much typically between sort of 70 and 80% of the opportunity for the chief investment officer is based on financial metrics. But there are still some things, especially for you setting up this organization, that it makes sense to have some of those individual metrics some of those other things that you need your CIO and your other senior roles to do that are important. Then it would scale down to 60% as you get to the more junior front office roles, and it would be 60% for all of the middle and back office roles. Out of that financial piece, 60% of the opportunity would be based on the fund performance versus the actuarial rate of return. We heard very clearly that that's a key element for NCIA to achieve the goals for actuarial rate of return under the plan. And so that has majority weighting for the financial metrics. We also have a total fund against a reference policy benchmark. And what that does is it does measure when there is outperformance of what is happening in the market based on the actions of the team. And so in that case, that's a relative metric. So if the general markets went up by 10%, you would have to outperform that 10% to get that piece. And then, as I mentioned, the individual and qualitative piece, that would measure individual performance. And our recommendation is to pull in asset class performance as part of that for those who have an asset class responsibility, rather than adding the additional complexity under the plan of having a separate bucket allocated to asset class performance. On the following page, we have the information on leverage. As we mentioned, our recommendation is for the payouts to go up to 150% of target. In the table, you can see in the middle of the table is the actuarial rate of return. This is our recommendation. Where your goal is at 6.5% minimum there, we have recommended having a threshold cut in at 6.52%. And so the goal there is to outperform that a little bit to allow to start paying for the plan. So that would be the threshold for that performance metric under the plan. Target would be at 8.5%, maximum at 9.5%, and it would be straight line interpolation between those different data points. For the reference policy benchmark outperformance, for threshold, again, we want 2 basis points of outperformance. So we want to have a little bit of funds there available to start paying for the bonus. So you always have that outperformance being able to help fund the plan. At target, it would be 35 basis points of outperformance, and at maximum be 52 basis points of outperformance. This is well aligned with what we generally see in the market. There was some modeling done of past performance, and this would be somewhat aggressive based on that past performance, but I think we've all agreed that the goal is even better performance going forward. So we believe that this is appropriate, and we believe that that maximum opportunity, maximum outperformance standard is appropriate given that we're doing the 150% upside. If you were saying you wanted to have an upside payout of 200% of target, then maybe you push that maximum a little bit higher, but this I think is very appropriate. Questions so far? Oh, yeah, and then the next page we have we've got the leverage and the measurement period. So this is the deferral. So when we're talking about the payout, the goal is to have the plan payout over time. And there's a couple of benefits of that. One of them is that it can act as a retention vehicle for your employees. So by having, our recommendation is to have half payout at the end of the plan period and 25% payout each of the next 2 years. That also helps smooth actual payouts in any given year once the plan is up and going. So you might have 1 year that is a higher payout and another year that's lower. That will help smooth those payouts somewhat. In addition, over the deferral period, the goal is to have those be in effect co-invested, being able to either gain value or lose value based on the performance of the fund. And so that is something council is making sure that we can do within your plan, but that is the goal. And so then there's also additional motivation for the team to push the strong performance for the fund.
If someone retires, does that get accelerated?
So very good question. That is our goal, to have that type of feature, and we actually go into that on the next page. We can actually, let's flip there. One of the challenges is we're working with council to make sure that we don't cause unintended tax consequences for people once they hit retirement age. So there's just some nuancing around that within the plan document that we'll have to do for retirement.
Does the board or some other entity have the ability to perhaps alter, and if someone's just resigning, if there is exceptional reasons that they maybe have earned that 3rd year?
Very typically, we do build in some discretion for the board. Again, I would lean on legal counsel for the appropriate language around that to make that most appropriate. Our recommendation is for the general provision for resignation or termination before the date of the payout would result in not getting a payout for that current period or any deferrals that are outstanding. And then for death and disability, we would recommend acceleration in those situations, and there's not as much of a concern around that from a tax perspective of doing that. For disability, it would be a defined disability, and so that would be something that we've written into the plan to make sure that that complies with the appropriate statutes.
Quick question, I didn't take notice before. Termination, does that mean termination for cause? Is that what we're?
Termination for any reason.
Okay.
North Carolina State would govern it anyway.
Yeah, we have largely exempt, totally exempt, so
Yeah, okay.
not a lot of statutory concerns. Maybe I could add just a couple of comments. I think the intent would be, if the board views this favorably, to approve this as phase 2, the base adjustments for the phase 1. That would be the market rate comp plan approved by the board. We still need to write a policy Under the board charter, the rewards policy is delegated to the CIO. So we would go through all the work with external legal counsel and including trying to design something where the deferred amounts could earn a rate of return, right? That would just be a notional crediting rate. It wouldn't actually be invested in the plan. And then the idea is this is a year-end December plan. So we would come when the data is available, which is typically around February, early February. So we would keep the same cycle. The board would have an opportunity in closed session to provide a rating on the CIO. So that'd be the qualitative component for the CIO. Give feedback on the team leads as well, because you'll have more interaction with them over time. And then we would put together our own ratings of all the team members. We'll have a good rigorous process around that to ensure it fits a reasonable kind of curve. Not necessarily forced ranking, but something in that neighborhood. Might rhyme with forced ranking. And then we'll come to the board with a report. We also report to the General Assembly any bonuses that are awarded. So we would have some visibility around what drove the ratings and the results and all that stuff. So that's our thinking. The board can redirect, of course. And we would have some flexibility in the policy around these special events that can occur. This is typical with all HR related policies. You have to have some flexibility to be realistic and pragmatic. But it would be an industry standard comp plan. Do you want to add anything?
No, I think the plan would put it, we're working with Tax and Benefit Council in DC right now about these exact questions that you asked. And what we'll put forward is we'll make sure that we're in compliance with those rules to make sure we don't blow any exemptions or hurt any individual employee.
So this came up on the conversation with Josh and Susan and Grant. And I was just curious what your perspective on this was, Kevin. So on slide 10, the reference policy benchmark outperformance thresholds. Did you do any sort of modeling at the asset class level, for example, to come up with a scenario around where you'd hit that 35 basis points just to get a sense of unintended, risk taking or misalignment or incentives that you otherwise weren't wanting to put in place?
Yeah, so first and foremost, both of the metrics are total plan.
Right.
The only, say, asset class level performance considerations would go into the qualitative assessment, right?
But on a weighted average, they're going to roll up.
Correct.
Right.
Yeah, certainly. So the schedule for the reference portfolio really comes first from looking at the projected outcomes over 10 years from Ortec. So that gave us a ballpark, right? And then we have a journey to get to the new strategic asset allocation. So rather than take the projected 10-year average excess return from Ortec and put it at the target, we put it closer to the maximum, right? Just to be pragmatic, that's going to take time to move the needle. We'll make new investments, but the large in-place portfolio still is going to drive performance for a while. So that was thinking. I think in terms of the risk environment, again, we have to fall back on our controls, which include regular reviews with the board around the risk taking and whether we're getting compensated for the risk. That's the way, in my mind, we kind of drive that. And then likewise in the investment committee as well.
I guess as usual, I'm just not thinking about the size of the passive portfolio and the ultimate size of the plan and how much, whereas from my world, it's the opposite. We would be so worried about what the excess return at the asset class level was to get me to my total plan.
That's right.
Return, right? So sorry, I just think about it the other way.
But the circle has to square eventually.
Yeah, they should, right? Eventually. I mean, bottom up and top down.
Yeah, exactly.
Yeah.
And so I think over time, this will get stretchier. The actuarial metric is already quite stretchy, right? But I think on the reference portfolio, that will get stretchy over time, and that's a natural tension.
When you get to 40% of liquid, it's really good.
Yeah, exactly.
It's really good.
Yeah. So again, I think that the team is open to that, right? We want the challenge. We want the ability to deliver.
Sure, it's a great problem to have.
But
Okay, one other question on the individual metric weight for your asset class heads. I don't disagree that we shouldn't add the complexity by putting it up in a financial metric. I'm just curious about your comfort level with whether or not you think that's an appropriate amount of emphasis for your asset class head when it's just a component of, for example, 25% for your asset class head. That's where you're going to see their outperformance in their asset class. Does that balance feel right to you?
well, again, this is just, qualitative, right? And it's just my opinion, but for a number of the portfolios, they're really unbalanced and malformed is a term I've used, which I think connotes the concept without being overly critical.
We're going to restructure.
Yeah, exactly. And so judging individuals' performance, like at the asset class level, is going to take a bit of judgment, right? Which is also an entree for the board to give us feedback around that over time, right? Because we can do a lot on the forward calendar, but we need to also manage the existing portfolio. And we are doing some restructuring, some exits. But it isn't so simple as just looking at a benchmark or 3 benchmarks and MOICs and right. So I think there's a little bit of art and judgment associated with that. So given your all's deep experience and expertise, I think, again, having input annually around how do you think an asset class X is progressing, given the circumstances of what they started with, the portfolio. And then there's a lot of other aspects that I think are quite important, which is team management. Are they building the right team, right? Which is, they don't do that in isolation. We all work on that. But that should also go into the kind of calculus, if you will. That's the way I think.
Thank you.
Sticking on slide 9 or 9, just when I kind of look at this side by side, just from a signaling perspective, are you comfortable with where the risk managers and the compliance are on their relative financial metrics? I'm just wondering if those should be lower. You don't want to incentivize, I mean, you want to make sure they're incentivized more on the individual metric than they are on the financial metric side.
Yeah, I get the concept for sure. I think my perspective is I want risk completely embedded. They're independent. They can offer up any challenge that they want. They should, right? We encourage that. But nonetheless, it's not like they're an affiliate, right? That is completely separate from the outcomes. We need to like manage it all together. So that there are different organizations that approach it where risk is more like a risk cop. And my view is risk management has to start, from the initial stages with the team that owns the risk, but then the risk team needs to be there alongside. And again, be fully independent, challenge all that. But we need to ultimately be rowing in the same direction.
We also have to multiply slide 9 by slide 8.
Sure.
Right. And where I think the rubber meets the road is the quantity at slide 8 for these people.
I really need to kind of do
Deliberately.
Okay.
Fair. Straight. Fair.
So if you'd like, we can look at the cost modeling in case that's helpful for you. This page, we just wanted to be able to show you what compensation levels might look like. So we've got the salary grade midpoint for each of the roles, and this is based on the prior approval. So as was mentioned, kind of phase 1 of this process. And then the incentive targets and maximums, and then what we call total cash compensation, so base salary plus incentives, would be at target and at maximum. And this, again, is not compensation for any individual. This is the midpoint of the salary range. So just want to make that note. So if you were to pay someone at the midpoint of the salary range, what the total package could look like. On the following page, we have the costing, so this is for the front office. And so we'll get to the middle and back office in a moment. And so for the actual incumbents in the roles, and using, again, those salary grade midpoints for as a stand-in for salaries, we've looked at the costing. And so this reflects the fact that some roles have multiple people in them. Some roles, like the junior investment analyst, do not currently have any incumbents. So this reflects the most recent employee counts that we had for each of these groupings. So the total cost of the plan is about $5 million at target, about $7.5 million at maximum. You can see here that the majority of that value would be to the front office for the investment specific roles. So we have everyone participating, but the majority of the cost of the plan would be based on these investment specific roles. On the following page, we have, so this is the middle and back office. And you can see here that the cost for at target would be about $350,000 for this team based on current incumbents, and at maximum about $520,000. So here you can also see that there are a number of roles that are not yet filled, and I think were mentioned earlier as part of that process of having an HR role, et cetera. So some of this cost is coming from some of those roles not being yet filled. So on the next page, we show the total cost, as I mentioned, at target would be about $5 million. And so remember that to pay out at that target amount would require hitting that, target performance for actuarial rate of return, as well as that outperformance target, as well as the individual at target. Maximum that could possibly be paid would be about $7.6 million. And this is assuming the full value of the plan, as we mentioned before, and I think Grant mentioned it, I think I went past it fairly quickly. For the first year of the plan, the goal is we're going to measure over 2 years of performance, 2025 and 2026, and it would be a 2/3 opportunity for the first year of the plan. We're not measuring a full performance period yet, and so the intent is to have a step into the plan. So the first year will be 2/3 of the targets listed, and then starting in 2027, when we have 3 years of performance to measure, then it will be the amounts listed here. And if we're looking at the cost of the plan as basis points for the portfolio, it'd be about 0.337 basis points at target, assuming the $150 billion fund, we're looking at that, the active part of that, or 0.5 basis points at maximum.
Just to say it out loud, that would be 1/600th of the excess return.
Correct.
All right.
Yes.
And one last number, just to remind me, so on phase 1, what was the dollar amount of position you plan to add? Shouldn't be reflected here, right? It was still around here, but.
Yeah,
Oh, okay, don't worry about it.
I don't know the number off the top of my
I think
head.
the point being, it's not going to balloon,
No.
this analysis relative to that.
No, I mean-
Because those aren't reflected, obviously, here. Yeah.
And that's about 20 positions at various levels that are not filled. And some of those, we wanted line of sight for more than others around where we might go, but there's no guarantee we're going to fill every one of those positions.
Thank you.
And one more number, as we talked about the target for the reference policy benchmark at 35 basis points, that would be about, $525 million of outperformance, and with the cost of the plan at about $5 million. So a small percentage of that.
And maybe just one more clarification either for you, Brad or Kevin. By statute, we can't be at more than 3 basis points on a trailing basis. So if we hit maximum here, and we're talking a basis point, and the amount of outperformance is staggering relative to trying to put it in perspective.
That's correct, yeah. And the three basis points applies to the total asset base. which is about 208 billion right now. So this is being sized just for the retirement systems. And if we were ever to get into a prolonged large drawdown in the markets where our AUM came down, the board has the flexibility around that 3 basis points to do the right thing from a fiduciary standpoint, right? So it doesn't like throw the brakes on, you have to like cut head count and do stuff like that. It's still a fiduciary exercise. So.
I know we all had a lot of time with our partners at Mercer, so thank you all for putting up with us. Thank you for getting to a good place.
We appreciate the active feedback along the process.
So we are now in motion mode. I will now accept a motion and a second to approve the market-oriented compensation plan from Mercer. Mentioned management is delegated authority to develop the rewards policy and other HR-related policies that accompany this. Do I hear a motion? Mr. Ward?
Second.
Russell, call the roll, please.
Ms. Lynch?
Aye.
Mr. Roberts?
Aye.
Treasurer Brunner?
Yes. Okay, we now have time for any board comments. If there are any.
I would say that this particular thing is really important to making sure that we attract the top investment people, not investment people associated with the whole process. And I think with NCIA trying to do what we're trying to do is going to really be critical that we do it. So thank you all for doing that. And thank you guys.
I think we ended up in a really important place from a political legitimacy and therefore a sustainability perspective, focusing on actuarial return as the key driver. That is what gets comfort for the average North Carolinian. Oh yeah, you were supposed to go do this and you did better than that. And they understand it and they believe in it and it'll help us stick with it. Moreover, culturally, I've lived in mercenary cultures. I suspect many of us have at different times. And this, I think, embeds an inability to get there, which is really important. It's got to be one team. You can't have team members fighting with each other about it goes in my portfolio, not in yours, and all those kind of productive exercises that I may have been party to earlier in my career. So I'm really pleased with where we got to. And so thanks again to Mercer. And thanks to all of you guys for the time you spent on this.
I think I'll just add from a timing perspective and sequencing how you've set the wheels in motion, changes you made early on, the demonstration of the outperformance last year, and now, continuing to modify the structure and the approach and then putting the incentive plan in place. That's exactly the way you would want to demonstrate good stewardship and good fiduciary duty. So just kudos to you and to Kevin and your team, because you guys are doing all the right things.
80% hard work, 20% a little bit of luck. We'll market in 2025 help. Okay, we have no public comments, so I will consider the public comment period closed, which brings us to the last agenda item, and that is a motion to adjourn. So moved. All right. Second. How about all in favor say aye? Aye. Thank you, everybody. We appreciate the time. Thanks.